Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and in the week ahead. It was another week where US trade policy really dominated market price action, with the US court ruling against Trump's trade policies. I'm joined by our two heads of G10 FX strategy, Brian Daingerfield and Paul Robson. And Brian, I'm going to come to you first to ask, what exactly was the ruling and what does it mean for US trade policy going forward?
Yeah, thanks very much for having me, Eimear. So a U.S. International Trade Court, which is a lower federal court, ruled against the Trump administration for the tariffs undertaken under the International Emergency Economic Powers Act, the IEEPA. This is the law that was used to justify a lot of Trump's more aggressive tariffs so far in his second term. So the entirety of the reciprocal tariff regime, the universal minimum tariff of 10%, and also his border security tariffs related to illegal fentanyl trafficking on Canada, Mexico, and China have each been effectively invalidated by this ruling. So this is a significant ruling, but it's one that we think that markets shouldn't overstate as a moment where trade policy risks move definitively to the sidelines. Because there are a number of different ways that we think this can break. We know the Trump administration is appealing this ruling, and that can move this ruling up to a higher court and ultimately to the Supreme Court, where it's possible that a higher court could issue a stay of this ruling and allow for the tariffs to continue to be in effect while a higher court judges whether or not this ruling is correct or needs to be overturned. That is something that is possible in the coming days as we record on Thursday. We haven't heard from a higher court yet, but we do know the Trump administration will appeal. Additionally, this ruling only applies to the specific emergency powers that the Trump administration used to justify these reciprocal tariffs. Now, this is one of many different trade authorities the Trump administration has. Some he used in his first term, such as the Section 301 authority, Section 232 authority, that are currently on the books and could be used again to justify tariffs. In the second term, he's leaned on this emergency powers in order to facilitate moving very, very quickly. So one of the features of the IEEPA is that because we're in a national emergency under the letter of the rule, then the Trump administration has the ability to act very quickly. We've seen that in action, of course, with very significant changes in tariffs, threatened tariffs. You've had moments of significant escalation, moments of significant de-escalation, and really everything in between. So what we think this means is that Trump will still have the opportunity and has the authority to impose tariffs. He just will have to use potentially other measures, other legal authorities. Many of those authorities are a bit slower paced, a little bit more methodical. So one of the potential ramifications of this ruling, if it holds, is that the Trump administration may have to be more methodical, may have to be a little bit slower. And from a volatility perspective, that could mean that the volatility surrounding the specifics of trade policy comes down a little bit here. I think markets would welcome that. But I don't think that this means that trade policy uncertainty has gone away by any meaningful stretch. We know that Trump has other authorities, some he used in his first term, others he didn't, in order to sort of regain this tariff authority. This ruling really limits one of the potential options the Trump administration has to impose tariffs, but does not touch any of the other options, although those options tend to be more methodical, they take a little bit more time, and maybe are more predictable in that sense.
And I guess with that in mind, that there's still legally a way for Trump to impose tariffs, even if it is at a slower pace. What does all that mean for the dollar and its outlook from here?
So we've been thinking about the dollar from cyclical and from structural sides, that, there's different pieces of this. I think from the cyclical side, this change, if it holds, is something that might help the US dollar and the US economy from a cyclical perspective, because, like previous de-escalations, this move has the potential to reduce downside recession tail risk from the US economy. That, if at the peak of the escalatory period in the aftermath of the Liberation Day tariffs in early April, the market's fear and concern was that these policies would drag the US into a recession, slow the consumer, and reduce the dollar and weaken the dollar via dollar losing its exceptional status. And the U.S. economy losing its exceptional status as the strongest economy in the world. Since we've seen de-escalations, we've seen the market sort of pare back that risk that the U.S. economy would fall into a recession. I think this ruling on the margin maybe increases that, maybe reduces the risk of recession that's sort of forced by tariffs. But again, this is something that's not necessarily the be all end all of trade uncertainty. It's not the be all end all for tariffs either. And so I think that risk is going to still hang over, and that uncertainty still lingers. Certainly from the cyclical side, we've seen some economic data have looked a bit brighter recently. Some of the confidence data we've had for, most recent has shown some signs of bouncing back, thanks in part to the delays and de-escalations and tariffs we've already had. So from the cyclical side, I feel like the dollar probably in a better position now, and in a better position simply from this delay. But the dollar's not out of the woods cyclically, we don't think. The tariff risks are still there, and we think it's possible that some of the upcoming economic data does show some downside simply because of tariff-related preloading into the first quarter. So a lot of the data from the first quarter continues to suggest that the economy, that economic actors, businesses, consumers preloaded some of their purchases to try and get ahead of tariffs. So I think it's likely that in the upcoming data into the second and third quarter, we do start to see a little bit of that give back as that preloading kind of falls out of the upcoming data. And so we still think there's cyclical reasons for the dollar, for the U.S. data to slow, and that could put the dollar under pressure. But to be fair, I think the cyclical position has certainly improved thanks to some of this de-escalation. On the structural side, still tracing concerns over dollar global reserve status, still concerned that international investors are looking more actively at hedging the dollar exposure of their U.S. asset holdings. That's something that could weigh on the dollar, even if there isn't, say, a full retreat from U.S. assets. And so we still think that the dollar risks lean to the downside here, even though the trade rulings today and more broadly the de-escalation has probably clipped some of the recession downside tail risk from the U.S. economy and from the dollar. So I want to ask you, Eimear, as well about emerging markets here, because, I think trade policy has been the dominant factor in all currencies, but especially in emerging markets, and broader risk sentiment has really swung around this. How are you thinking about not necessarily just this ruling, but the broader trade stance of the U.S. as you're thinking about emerging market currencies here?
Yeah, we're still broadly bullish on emerging market currencies. And we think, the ones that will perform the best are the ones with the best chance of securing a US trade deal as soon as possible. What we've seen from Trump is that he really kind of tries to prioritize trade deals with countries where he has the biggest trade deficit currently, and also where he's looking to build, political strategic allies. In particular, he really seems to be focusing in on Southeast Asia, probably as he looks to kind of build strategic alliances within the region against China. We do think, it's a big, impetus for the currency if you are going to get a trade deal. Number one, because these economies are very trade dependent. And number two, the risk that the US accusing a country of currency manipulation and jeopardizing a trade deal could actually see these kind of domestic policymakers adopt policy which actually encourages FX appreciation, just to avoid any kind of risk of being labeled a currency manipulator. In particular, we're looking at India. We think that is going to be one of the soonest economies where the US will manage to agree a trade deal and finalize one. I think it was pretty obvious actually from the get-go that China was really favored in a trade agreement with the US. India is actually quite a protectionist economy. Its customs duties on imports is around 17%. You compare that to just 7.5% from China, and Thailand at under 10%. And yet when the US and Trump imposed his reciprocal tariffs, India had one of the lowest reciprocal tariff rates within that Asian region. I think it is kind of twofold why the US really wants to kind of finalize a trade deal with India. I think number one, that idiom that, your enemy's enemies are your friends really holds true. India has historically had quite, a strained relationship with China. I think also, the fundamentals of the Indian economy, right? It has the world's largest population. It is expected to be the world's fastest growing major economy over the next 2 years. And it's got a growing, higher middle income class. So really kind of gaining US companies access to that market would be a significant political win for the Trump administration. We do think this spells, quite a positive outlook for India if they get a trade agreement reached. I think on top of those kind of enviable growth dynamics, you also have the potential that it really catalyzes equity and bond inflows into the region. But another region that has been in the focus of Trump's kind of trade back and forth is definitely the EU. And Paul, I've got to come to you on this one. Trump had suggested a 50%, increase in tariffs on the EU. Then we had kind of a reprieve, kind of pushed back slightly, and negotiations we know are ongoing. But how is the euro digesting all these kind of fast-paced dynamics?
Yeah, it's very much a week or last couple of weeks of escalation, de-escalation, more escalation, and certainly in trying to impose, or at some point, 50% tariffs on Europe. It was actually quite interesting. You said a lot of interesting things, but I thought the reference to US trade deal, or at least talks going a little bit better with China than Europe. I think if we jump back to last November, I don't think people would have necessarily expected that, and so it's new and important information. I think ultimately it's going to be important where it settles down. I did wonder this week whether there was a little bit of chicken and egg. Did Donald Trump mention the 50% tariffs because the EU was going slowly, because they were actually going more quickly and he wanted to take credit for that? Or was it actually, did the EU start to pick up the pace of talks because of the threat of tariffs? And of course, we'll never know. But if we settle down for universal tariffs of 10% on European goods, it should only really be a rounding error on European growth and inflation. But obviously, if we escalate, and on the European side, if they choose to escalate and this rumbles on for longer, then it will have a sort of bigger impact on growth. For the euro, I think it matters in sort of two ways. One, and I think we'll talk about this in a moment, is how quickly, or could the ECB go a little bit more aggressively, and does this uncertainty mean they don't cut aggressively and they keep everything broadly as they've been sort of guiding to this point? And the other one is the point that Brian made about FX reserve diversification. You've got retained earnings, you've got hedging of US assets, asset allocation, and ultimately, because of this uncertainty, because of this back and forwards between escalation and de-escalation, does Europe turn out to be a destination for any capital that ultimately leaves the US? And these decisions aren't taken within a couple of hours of a trade escalation. They'll play out over months and quarters, and I'm sure that the three of us will be talking about this for a lot longer this year. Hopefully, we can move away, but it's very much a dollar world, US policy world. I'm jealous of Brian having so much to talk about. At this point, I think European currencies are sort of a beta on what happens in the US. I don't think there's a huge story at the moment, but maybe that will change during the rest of the year.
Yeah. And I have to ask you about the ECB meeting next week. I mean, they are making a decision with so much uncertainty kind of in the background. So how do we think that decision plays out? And how sensitive is the euro at this stage to ECB policy action?
Yeah, I think pick up the second point of that question. I think the euro isn't really that sensitive at the moment. I think it is this beta on what happens to the US and capital outflows. And there's been a loosening between euro dollar, for example, and interest rate yields. Regular listeners will know that Brian and I talk about this a lot, about being important for major currencies, G10 currencies especially. And then there's the other driver of commodities, but it tends to be yield. But it does matter if the ECB was to cut rates aggressively and the Fed was to worry about its inflation fighting credibility and keep yields high in the States and markets readjust, then that would be important. I don't think you'll get much out of this next week's ECB meeting. Markets are fully behind the idea that the ECB will cut a quarter point. Only a couple of weeks ago, markets were worrying about whether the ECB would actually follow through on some of its previous guidance. We think they cut again. And I think one of the key things about next week's meeting will be it feels like the ECB is close to its landing point for this monetary policy easing cycle, we talk about terminal rates in the cutting cycle. But where are the risks around that? Well, at the moment, they seem fairly balanced. Growth has been a little bit stronger than expected, inflation a little bit weaker. On balance, maybe they're skewed slightly to lower rates. But as you say, there's lots of uncertainty. And I don't think that there's a dominant piece of data that's come out to justify moving rates below sort of neutral, their fair rate. So, and that will be reflected in the economic forecasts, I think, that we get in terms of growth and inflation. I don't think they'll be moved significantly. There'll be the usual questions and sort of hints about rates into the future, but I think that given the uncertainty, waiting to see that balance between escalation and de-escalation, where do we settle down? And for now, cut rates a little bit, inflation's coming lower, more quickly, obviously, than in the UK and the US, and that's important. At some point, weaker, lower interest rates will stimulate growth, and that will help the euro. But that's a story for another month or quarter ahead.
Another podcast where we have definitely moved away from the world of relatively monetary policy, and it's now all about US trade policy. Guys, this is probably all we have time for today. Thank you both so much for joining me for this week's podcast. Thank you so much for joining, and do like and subscribe to the podcast so you get the latest episode first. Thanks again.